So, how to pay your home off early? We're going to talk about that next. Hey there, my name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates. We're going to start with those interest rates. Well, the average 30-year fixed, according to Freddie Mac, is 6.6. You can check out the link below. We've basically been in the same range here for the last, I'd say, 3 weeks here, within about an eighth in rate, or about 10 basis points. So 6.7, 6.6, running around in that range, off the highs that we saw in late October, November of last year, just over 7. So while you're down there checking out that link, hit that like button, hit that subscribe, and click that bell icon to be notified as I'm putting out weekly videos on the channel. Now, what we want to talk about today, the topic at hand, how to get that mortgage paid off early. How do you get this house paid off early, right? So I'm going to go down to the most basic understanding in math here, and that is shortening your term. Not making bi-weekly payments and make one extra payment and do this and round up that, and the complexity to that, and you'd have to put all that math in an Excel sheet to be able to look at all this and say, you know, I have to do what to pay it off early in 7 years? Well, here's what I'm telling you, is that likely interest rates are going to be lower. It is now March of 2023, so looking at late 2023 into 2024, we're likely going to see rates lower. Most projection, most economists, most large entities like Fannie Mae and Freddie Mac are all suggesting that interest rates will be lower. At that point, consider a shorter term, like a 15-year fixed, like a 20-year fixed, as opposed to the standard 30-year fixed. So at that point, when interest rates start to go down, you want to look at and say, what would my payment be on, say, a shorter term? And that is going to allow you to pay it off early. Very simple, right? Not some huge secret. Just look at a shorter term instead of that 30-year fix. Now, you've got to look at what is that monthly payment. You've already been paying X, and then all of a sudden rates go lower and you refinance into, say, a 20-year term. Maybe you have that same payment. So you didn't reap any savings on a monthly basis, but you are going to pay the mortgage off sooner. Let me show you a quick chart here. So as I put up here on the screen, you're going to be able to see the 30-year fixed, the 20-year fixed, and the 15-year fixed. And if you look at these charts down here on the bottom, you're really going to be able to tell now is the amount of principal compared to the amount of interest. Now, the amount of principal on a 30-year fixed is typically going to be about 1/3 of the overall payment. Then when you go to a 20-year fix, you see in the middle here, now you're looking at about 50% going towards principal, 50% going towards interest. And then in the far column there, you're going to be able to look at the 15-year fix, where it's about 2/3 towards principal and about 1/3 going to interest. Now, this is going to allow you to pay that mortgage down significantly sooner without making extra payments. But again, you have to feel comfortable with that payment. And I also want to recommend that you have to feel comfortable with that interest rate savings. If there's only a small amount of savings from a 30-year to a 20-year fixed, like maybe it makes sense to still do the 30-year and just pay extra, right? So if you do get a significant amount of, say, interest rate savings by going down in term, then at that point, that's really where you're going to be able to have a significant savings and be able to pay that off sooner. So now, last but not least, I want to put an asterisk by all this, is that I absolutely am not giving financial advice, but with that said, here's my personal opinion on people that go in and say, I want to pay my mortgage off. I'm always asking the question of, are you maxing out your retirement? Are you putting money aside, in an investment account, in a taxable account, a non-retirement account? Do you have ample savings, in case of emergency? If you're doing all those things, then it would make sense to really go after that mortgage debt. Want to make sure you don't have any other higher interest rate debt out there or anything like that, because if you do, it's going to make more sense to pay that off first than the actual mortgage. So, in summary, if you want to get the house paid off sooner, look at a shorter term. Now, it might not be right now if you're looking to purchase a new home, but it might be when those rates go lower and you look to refinance. So put those comments below. I'd be forever grateful for the subscribe. Stay safe, and we'll see each other again very, very soon.